Well, good afternoon, everybody. Thank you for tuning in to our weekly webinar at High Rock Capital Management. My name is Scott Tomlinson, and we have on the call today my partner and colleague, Paul Tepsich. And we're really happy that you could take some time out of your busy schedule to join us today. And we want to talk about a couple of things. So one thing that we've talked about, and I continue to talk about, is just what it is that we're doing and why, and I want to make sure that it's very clear for everybody. So let's talk about High Rock just in a broad way. Paul Tepsich founded High Rock as an asset management firm in 2010. So that's 5 years ago. Paul's been managing $200 million across four funds for Scotiabank. And so we have this established asset management firm, and what we've come together to do, Paul and I, is to create and take all the synergies that we can from this asset management company and create a private client division where we think we can bring those synergies to provide a very unique client experience for our private clients. And let's talk a little bit about that. I know this is a review, but I want to go through it one more time. It is a holistic, goals-based wealth management private client group. So that means we want to sit down, understand our clients' goals. We want to create a plan based on those goals, and then bring in a portfolio strategy that makes sense based on that plan. For us, that is what it is about, very much tailored to each family that we look after on an individual basis. We think that our, as I said before, the synergies that we were able to bring together in the asset management company help us to bring the costs down. And that, we think, is really important. It doesn't mean, and I've been managing portfolio models for the last 5 years with some very good returns. It doesn't mean we're changing any part of that strategy, except that we're finding places where we can lower the costs for our clients, so obviously they don't pay as much, and in the long run, that's a very helpful situation. When I say one-of-a-kind, conflict-free fiduciary responsibility, the one-of-a-kind is that we have a very specific part of the practice that is monitored by an outside specialist who has experience with the Ontario Securities Commission, who ultimately is our who we report to. And what this is intended to do is have this individual report directly back to our clients to say, hey, this is a company that is doing all the things they said they're going to do. They don't have any conflicts of interest, and that is the monitoring that we're going to have to make sure that our clients have the confidence that we're doing what we say we're going to do. Okay, so that's basically what High Rock is. I'll talk a little bit at the end of the call about our models and what we're doing with our models, as well as perhaps cover what that low cost on a comparative basis can give a client. But really what we want to do today is cover a couple of themes. And one of those themes has been from the beginning of the year, and I cover this in my blog on a regular basis, is that this is the year that we expect the unexpected. That's what 2015 is all about. And certainly it started at the beginning of the year with the oil shock repercussions that came. And throughout the latter part of 2014, we saw oil prices plummet. But it was what happens, what are the repercussions from those plummeting oil prices that really are impactful. And that's the unexpected. And one of the things that we saw was certainly at the Bank of Canada, they dropped the bank rate from 1% to 0.75%. Other central banks have followed through as well, as the impact of lower oil prices made or added significant deflationary pressures to the global economy. Other central banks brought in very stimulative monetary policy in order to help fight that deflation, help to get economies up and going, and to help fight deflation. They're still in the process of seeing what the results will take some time. Certainly the European Central Bank, we're starting to see a little bit of positive economic data coming out of Europe, but we're not seeing that in Asia or in the emerging markets area at this point. Even in the UK, it looks like economic growth has been stalling, but not only in Europe and the Far East, but also the impact of the quantitative easing on a global scale has had a significant impact on the U.S. dollar. And here's just an idea. Here's the euro against the U.S. dollar. So the U.S. dollar has risen significantly as the euro has tumbled. And one of the big surprises, perhaps not so much to us, but perhaps to market participants, has been the impact on the U.S. economy. And with the stronger U.S. dollar, some not so great weather in the early part of the year, last week the U.S. reported GDP growth for Q1 as having grown just 0.2%, which was a significant surprise and another unexpected event. That tells us, though, that the impact of the U.S. dollar being so much stronger is having a pretty significant influence on what's going on in the U.S. economic situation. Now, that is, of course, the unexpected that we've seen so far this year. What about the rest of the year? Well, let's talk about what's expected. I think right now the markets expect that the Federal Reserve will raise interest rates in the United States by 0.25%. In all likelihood, that is expected to happen in September. Will that happen? We remain to see, but it is the year of expecting the unexpected. There is a school of thought that says that the economy may not bounce back as quickly as many think, and certainly the U.S. dollar may have be a factor in that. So, although a lot of experts are expecting the second half to see the U.S. growth, economic growth pick up, that's what's expected. And again, this is the year of expecting the unexpected. So we want to be cautious and wait to see how that all unfolds. Equity markets. Well, you know, it's interesting. The more people we seem to talk to, the more think that equity markets are the only place to be putting your money. Well, we don't believe that. We think that there's some issues with equity markets. And here's a chart that I showed briefly last week, but I want to get into it a little bit more in detail this week, because it was very interesting. Back in 2011 and 2012, I had a lot of clients who were very concerned about putting their money into the U.S. equity market because there was a lot of disturbing things going around. You know, worries about double-dip recessions in North America, worries about Greece at that time, worries about what was going to happen to the global economy. And even though earnings continued to, the fundamental that drives share prices, or should drive share prices, is earnings, and earnings continued to be reasonably robust. And back then, that represented value when there was a discrepancy where share prices were low, but earnings were relatively strong. Since 2014, however, we've started to see that situation go the other way, where earnings continued to grow until very recently, but share prices grew at a much more rapid pace. We think that makes share prices expensive. That makes us want to be cautious with regard to what we think share prices and where share prices will go. One of the reasons that share prices have got expensive is that interest rates on a global scale remain low. When interest rates are low, it means investors to get growth, and investors don't have a lot of patience, unfortunately. When they can't get reasonable returns today in safe markets, they'll extend their risk to get better returns over a short period of time. It's that instant gratification scenario. Everybody wants to get it happening right away. Well, Paul and I are very cautious, very patient to let situations develop, let opportunities arise, so that when we put our client money to work, we're doing it at what we think is the best possible time. We just don't want to throw your money in the market at any price and then wishfully hope that it will continue to grow. We want to be very specifically selective when we do start to put money to work. And right now, we're getting very cautious about how we do that. So earnings, a key fundamental. Right now, the forward 12-month S&P price earnings ratio is at 17. The historical average is closer to 14. It doesn't necessarily mean that equity prices are going to plummet tomorrow. One of the great economists of our time, John Maynard Keynes, said that markets can remain illogical longer than you and I can remain solvent, which basically means you don't want to bet against them, but it does allow us, if we want to be a little bit more cautious, and that's really what we're trying to do here. So what else is expected? Well, right now we're expecting the second half of 2015 to see, or not necessarily us, but the markets are, to see better U.S. economic growth. And at the same time, that's anticipated to be what drives economic growth on a global scale. It's just not clear that that's necessarily going to happen. So we're being very cautious. One other thing that we've been closely monitoring, of course, is inflation. It's interesting. Oil price declines and have impacted the total consumer price index, certainly in Canada. But you can see the brown line where on this chart where the core CPI really hasn't been pulled down. In fact, we're starting now to see both core CPI and total CPI start to edge higher. Interestingly enough, if you buy a 10-year Canadian government bond at where it's currently trading at about just a little under, or say around 1.8% or so, but you've got the core CPI at over 2%. The real return, the difference between the return on the 10-year bond and inflation is actually negative. So if you're buying bonds at this particular point in time, you're actually getting a long-term negative return, and we think that is it can be a bit problematic. We've seen that how that's been impacting bond markets lately. Before we look at the bond markets, let's also look at what's going on in Europe in their inflation deflation situation. As you can see, through most of 2012, 13, and 14, and even into the beginning of 2015, inflation has dropped significantly to the place where it was in negative territory. And right around then, we started to see German bonds get close, 10-year bonds get close to zero. Subsequently, in the last couple of reports, inflation has started to come back closer to that zero level, and that's had an impact on bond yields. So we've seen now bond yields in Germany rise from close to zero all the way up to near 50 basis points. So that's quite a dramatic move in a short period of time. It's also been impacting Canadian bonds. We're starting to see Canadian bond yields rise across the spectrum. Basically, that means that we're not expecting weaker growth in Canada in the near term. We think we've seen most of that weak growth, and there is some expectations of better growth. Last week, I mentioned that Governor Paulos thinks that the U.S. economy in the second half will be what pulls the Canadian economy higher. So at this juncture, with that indication, Canadian government bonds are starting to actually build back in some inflation into the Canadian economy. As well, we're certainly seeing it in the U.S. Bonds as well, moving higher in yield, lower in price. And again, market participants are building in potential inflationary or higher inflationary situations going forward. Paul's on the line right now, and I'd just like to see if Paul, as one of our resident bond experts, would like to chime in on what he sees when he looks at these bond yield curves.
Thanks, Scott. Well, they certainly have been beaten up very hard, but again, I think they were probably, as you mentioned, very overbought as German bond yields, 10-year yields in Bunds got down to about 12 basis points, as you said, pretty darn near zero. And I think today, in fact, they're up, right now, I think they are up at 51 basis points. So we are, at 3-month wides, in fact, year-to-date wides, wide yields or high yields in most of these government bonds. I would argue, though, that we have, although the bond market, government bonds have rallied and rates went down, prices went up too much, too far, too fast, I think the opposite is now occurring. And the only reason to buy them, and although the inflation argument appears to be bottoming and if not ticking up, the reason to own government bonds in 10-year and 30-year, which our portfolios will, is a portfolio hedge. And Scott, you may want to expand on that a little bit, but basically, if and you can look at the German stock market today is down, close to 3%, for instance. All the European bourses are down 2.5%, 3%. If there is a big run on equities and they start getting hit hard, people will move out of equities. They'll rotate out of equities and into government bonds for this so-called flight to safety or flight to quality. And that is a reason to own government bonds, because it does hedge up your portfolio. And now, Scott, you just put that slide up with fixed income, global equity, and Canadian growth equity are 3 models. And we will own government bonds in the fixed income model because it will help balance out the risk that we own in the global equity model and the Canadian growth equity model. And that is balance and diversification for us.
Paul, one of the things that we've been doing, and I'll maybe get into this a little bit more in a moment, but we've been really taking a hard look at what we own in the fixed income range of products. And what we have decided is that, as you just said, we want to start to maybe add a little bit of duration to our portfolio, and that means that we want to actually move where we've had some of our portfolio or more of our portfolio in shorter term bonds. We actually want to now extend our terms a little bit, because we think that longer term adjustments are occurring quicker than they may necessarily need to. And we think that we can take advantage of those adjustments because, and again, without adding significant risk to the portfolio, as you said, because if there is a move to safety, those are the areas that people are going to move to, and that will actually bring prices back up again. So what we're trying to do here is look for opportunity to buy bonds at a bit longer term. So when I say duration, I mean that's a longer term perspective. But what we want to do is buy those longer term bonds, and we think that they're getting to a point where we can actually pick them up very cheaply for our clients.
And Scott, we probably also just want to mention here that given our 30-year track or experience in the bond market, 30 years each, one thing we do know over that 30-year period and longer is that bonds, government bonds, lead all financial markets. And you need to pay attention to them, and we do every day and intraday. Right now, I think they're telling us they were they were very overdone. But I think we're getting to a place here where, when you get to 10-year yields around 2.25, there are also very structural needs or demand for 10 and especially 30-year government bonds in the U.S. But that goes around the globe, and that demand is a structural demand coming from private pension funds and public funds, but private funds are enormous. And some funds, like in the UK, private pension funds can't own equities. They have to own bonds, and to match the duration of their liabilities, which are very long-term, they need to buy long-term bonds. And I think that's part of the demand that we're seeing, and we've seen over the last while in the long end of the bond market.
So our focus right now is to be having maybe a little bit more cash parked, waiting for better equity prices, but to make sure that we've adjusted our fixed income portfolios to be a little heavier in government bonds, right?
Agreed. And just one thing here too, Scott. I'm just going to add, and it might have been one of your first or second slides, but this is a good slide that you've got up on the page now, just to comment and say that part of the reason why we started this private client sleeve is for Scott and myself to manage our own personal accounts, household accounts, and family accounts in what we see as a very effective and efficient vehicle using Raymond James Custodial Services as our custodian and back office. So really importantly is that we are investing in all three of those models up on the screen: fixed income, global equity, and Canadian growth equity, as all of our clients. We're invested right alongside you, and we're doing what we think is right for everyone. For our household accounts and all of our clients, we're all being treated the same way. So you can rest assured that the decisions we make, we've got our skin in the game on all of these models.
And that brings us to another point too, Paul, because I've had a conversation with a couple of people over the last week, and in those discussions, they've referred to us as being sort of new players in the portfolio management world, and I'd like to make sure that everybody understands we're far from new players here. We have been around for an extremely long time. You've been in the markets for 30-odd years. I've been in around 35-odd years. I've been managing private client portfolio models since 2000, basically, and with great success in the last 5 or 6 years. So we may have a relatively new entity, but we are far from being new to this particular style of management. And one of the things that I want to make sure that we iterate to all our listeners is that we have a lot of history, and it's that history that we're using to make sure that we're doing all the right things by our clients.
Could I be so bold as to say I doubt there's an investment advisor in the country that knows as much about fixed income, from government bonds through to high yield and distressed debt, as I do? Can I say that?
I think you are the expert in this country in high yield and distressed debt. So that is something that we know, and you've been managing the funds that our clients have owned and provided some very decent income distribution without any real grind or devaluation of the net asset value of the portfolio. So,
or risk-adjusted returns. You may want to mention that, how the return versus the amount of risk or volatility of those returns that you're taking has been extremely high. Or pardon me, the return has been high versus the risk.
The relative return is high.
Right. And one more thing, Scott, as well, and you talked again about the first or second slide, is the synergies, because we were, up until a month ago, really just an institutional asset management firm managing $200 million across 4 funds for a division within Scotiabank. and we've been vetted and had due diligence performed on us. We have by every bank in the country. We have due diligence performed on us every year by Scotiabank to ensure that everything is lined up with regards to our registration, and we are registered with the Ontario Securities Commission, which is obviously a government agency, not like the broker-dealer network. We're registered by IIROC, the investment industry's self-regulatory body. And very importantly here is the fact that we are, especially in the bond market, but it goes to the equity market as well, because we do trade stocks on the institutional side, is that we are in the bond market every single day on an institutional basis. That means that we have pricing on an institutional or very high level base from every bank in Canada and some of the smaller independent dealers and most of the Wall Street firms. So our price execution is beyond what any investment advisor in the country would get. And in fact, that's why a lot of investment advisors hire IIROC, in fact, to manage funds for them through the Scotia funds, because they can't do it on their own. That's one of our key advantages. So it's the synergies between our institutional business that we get, price execution, some research, company meetings, etc., that we can now, and that's why, again, part of the reason why we started the private client business, so that Scott and I could actually access the bond market in a more effective, efficient way. And our clients get the benefit from that. We don't take a cut on any bond trades we do, like an investment advisor would.
So that, I think, is pretty much all we want to talk about today. Paul, I see as a list of attendees on our client call, or our call today, we have a new record. So I'm going to open up, and maybe some of these folks who are paying, or who've taken the time to listen to us have some questions. So I'm going to open up the floor to anybody who might have a question. Well, Paul, I think we've answered all their questions for today, but I would encourage anybody to
or they're too shy, Scott.
Well, that may be it.
Sorry, I was saying, or they're too shy.
But I would encourage anybody, if they do have a question and they're not comfortable speaking up on the call, please send us an email. Please give us a call. We're always happy to answer questions. Part of our what we want our client experience to be is the communication factor, wide open communication. We want to make sure that if you do want to have a conversation over any particular point, that you get in touch with us, because that's very important for us to make sure that you're all comfortable with what we're doing. Anyway, thanks again for tuning in this week. Look forward to chatting with you next week at the same time. And I hope you all have a great week from now until then.